The question pause here, I'll try to bring some evidence to try to answer this question. Although in a summary statement would be that in the long term it's very hard to say what influences cooperation, whether activist hedge funds have done so or not. One thing is for sure, they don't care whether they have a long-term effect. Once they're out of there, if the company does well, great. If it doesn't, so be it, because that's not their game to really look after the long-term welfare of company. Really, are they making cooperation better for all stakeholders? We are a bit lost in time, this notion that companies have more than shareholders as stakeholders. I know it's not very popular in some quarters, but it is an issue, and it is a social and political issue that may bring problems further on with this. Of course, what's long-term, what's short-term is always a difficult question. It's sort of set, fixed time frame. 3 years may be long-term for some, short-term in other industries. I've tried to propose a definition here, what I mean by short-termism, corporate short-termism. Basically, it's a conscious decision under external pressures or not by management board to take action that will bring benefits in the immediate future, knowing full well that this action may prove eventually detrimental to the welfare of the company. Now, it's not that doing something short-term is bad. It's bad when actually there is a notion that what I'm doing now, I know there may be adverse consequences moving forward. Is there evidence of corporate short-termism? Yes, there's a number of studies which tend to show that. The last one is by Barton and Wiseman. Barton is from McKinsey. Wiseman is the CEO, actually, of CPPIB, the largest pension fund in Canada, and published in Harvard Business Review. McKinsey did a survey of 1,000 board members and C-suite executives. What they found, 63% of respondents said the pressure to generate strong short-term results had increased over the previous 5 years. 79% felt especially pressure to demonstrate strong financial performance over a period of just 2 years or less. 44% said they use a time horizon of less than 3 years in setting strategy. 73% said they should use a time horizon of more than 3 years. And 86% declared that using a longer-term time horizon to make business decisions would positively affect corporate performance in a number of ways, including strengthening financial return and increasing innovation. Now, it's a survey. They responded to a survey with all the limitations of surveys. Still, that's what the CEOs and board members told the interviewers. Now, we all know that governance is imperfect. And the terms imperfection are used in economic terms. It's imperfect, and it created, in widely held corporations particularly, I would say that board members are generally responsible, dedicated people, operating, however, in a framework of fastidious, punctilious governance. And in times, that governance became even more fastidious and punctilious. We keep adding on the ISS and so on, this will keep adding on requirements of governance and so on, becoming increasingly so. However, under the current governance imperatives, cannot resolve the dilemma of asymmetric information, the fundamental agency problem of board that makes them vulnerable, that generates a governance imperfection. Over the years, various players have tapped into this governance imperfection. First, private equity fund in the 1980s, and they still do, but they were huge. They were called LBO funds, by the way, in those days. And more recently, hedge funds. Institutional investors have also become active in demanding better but fiduciary governance. They tend to, again, ask for better governance of the sort that we know and we can improve, try to improve, but they are never addressing the fundamental imperfection of governance. Corporate short-termism, what are the causes? I'll go quickly. There's a good white paper by the conference board on the subject, so I won't spend much time, but it's important to remind ourselves. Shifting belief about the purpose and responsibility of modern corporation. The stakeholder model has been dropped. Shareholder value maximization around the end of the 80s. Ownership structure of corporation, certainly in the US, the dominance of widely held listed corporation, the gradual elimination of the board as buffer. It's not true everywhere. I mean, in Canada, of the 100 largest companies, about 40% have controlling shareholders. 100 largest companies. So they are out of range of activist hedge fund. They've tried once or twice and they lost so miserably that they said they vow never to attack again a controlled corporation through dual class of share quite often actually. Perverse incentive throughout the economic system. Yes, we know about compensation issues, but throughout the economic system, not only at that level, but at all levels where compensation has a short-term bias. The tyranny or collusion of quarterly guidance in an analyst meeting. One has to listen on these meetings or read the transcript to see what kind of pressure is put on the CEOs for immediate performance. What are you going to do next quarter? What are you going to meet? What is your guidance? What is your guidance? What is your guidance? Are you going to meet that? And I mean, that kind of pressure is eventually gets to management. How can they? And they know that these analysts are going to go out and then write their report with a hole, if they're lucky, sell if they're not, of course, and hopefully buy if they do a good job of convincing them that some good things are coming fairly quickly. And of course, the pressure on corporate directors from investors of all sorts and governance enforcers. ISS et al. Are actually governance enforcer. And tax policy favoring short-termism, certainly in the US and in Canada also. I can't leave that subject without showing a bit of the report on the Lehman bankruptcy. It's good because it's a 1,000-page report on the subject. And the conclusion about the board is quite striking. Although Lehman's management did not provide the board with all available information concerning the risk faced by the firm, the fact is not surprising given the board's limited role in overseeing the firm's risk management and the extraordinary detailed information available to management. And in monitoring risk issues, the board justifiably relies entirely on information provided by management. Under Delaware law, the directors are thereby immunized from personal liability. This is a report from the examiner. So what I mean by governance imperfection is exactly that. The board of Lehman did what it could. Board members, several former CEOs of large corporations, exercised their business judgment, a judgment shaped by an experience totally foreign to the investment, banking, trading business in the years 2000, 2008. They made decisions on the basis of their limited knowledge of the trading business and the information provided to them by management. Can we eliminate this governance imperfection? Well, there are three ways actually. One is the soft way of institutional investors, although we may soon reach a limit. The hard way of activist hedge fund, lucrative business, but for whose benefit, which is a bit the theme here. And transform government with boards made up of activist members, less independence, more credibility on board. That's the topic of our next book, so that'll be the end of the meeting today. Two forms of activism. We know well the institutional investor, what they do. They're constrained by fiduciary duties, highly diversified portfolios, small stakes, no economic justification for an activist or activists of the hedge fund kind. Really targeting governance guideline. Exit sometimes is simpler than voice. Fairly short holding period. I put that in quote because I'll get back to that. Driven by governance and socio-political issues. Some success in time. This number of companies of the S&P 500 with staggered board and poison pill. And the number have come down dramatically, which in a way is opening the door to activists of a different kind, obviously. So there is an indirect collusion there. Activists hedge fund, I say quite often do the dirty work for institutional investors. I've seen that, I don't know if they're here, but in the Canadian Pacific Rail, the first fund eventually to come out in favor of Pershing Square was Ontario Teachers. I mean, the Teachers Union pension fund came out saying, that's good. we support that. Surprising. Fewer regulatory constraints, better incentive, of course, can depart from classic portfolio management, larger interest in fewer corporations, engage management and corporate boards, and prepare to become hostile, encourage traditional investors to tag along, driven strictly by financial return. Some evidence of investor short-termism, but not a very recent phenomenon. Of course, we all know this curve, which is the average holding period of stock in New York Stock Exchange. Used to be in 5, 6, 4 years. But look where in 85 it's already under 2 years. And of course it accelerates because of speed trading and so on. So but what's interesting is to look at actual pension fund and money manager investment corporation. From 85 to 2010, it hasn't changed much. But doesn't mean that they're long term. I mean, the median holding period is, if you look at 2010, for banks, it's bank and insurance company, 1.62 year, 1.41 for investment, 2 for pension fund, others 1.23. So that's the median. It means half the funds have a median duration holding period of less than that. The other half is about. And, well, we see them graphically, hasn't changed much, but oscillates between 1.5 and 2 years since 1985. Now this is interesting, this FIFO, round trip traced by funds, money manager, pension fund, and look at the time that they stay in. So it's first in, first out, the stock was bought and sold. What's the time period in between? And you see that 1 year and less, 70% money managers, 65% of pension fund, it's out. Half the funds in that period. I mean, 2 years is important because later I'll talk about transient shareholder, and the criterion is 2 years and less, being a transient investors. Well, you have here that half the fund keeps their stock for 90% of them for less than 2 years of their stock that they have. So they themselves are pretty short term in my view, and that's part of the problem that we have. Now, the hard activism of hedge fund, we know. It's interesting to see what they want. Selling the company, going private, 23 to 30%. Many studies on that, of cases. Unbundling, sale or spin-off of division asset, 18 to 32%. Disgorging cash, special dividend, share buyback, debt restructuring, 20 to 36%. Changing governance, strategy and management, 30 to 40%, which may be only a first step to the others, of course. I have to get on board if I want to get some of the other stuff done sometime. Pursue growth strategy. Interesting. 1 to 2% of cases. This is another study which has looked at the same phenomenon, but again, board replacement, CU 35, 36, payout, share buyback or increased special dividend 21, 20% restructuring, divestiture, takeover, target firm is acquired by a strategic buyer or private equity fund, and total outcome. This is actual outcome. It's not an intention, it's actual outcome. Now, the question is fundamentally, let's forget about all the statistics I'll present about studies who try to measure that, is how is that good for companies if we do that everywhere? That's really the issue. How good is that? What does it do to companies to systematically apply this recipe to the whole S&P 500? Why not? Holding period. This is from beginning to completed spell, it's called, beginning to the end, to the announcement, for a large number of deal. The median period of time is 229 days, or 266 if we mix hostile and non-hostile. So 266 days, it's actually calendar days, so it's basically 9 months is the median holding period between the two. So they're certainly not long-term investors. Now, they're not that much shorter term than many of the investment institutional investors that I showed earlier. So that's an important point as far as. Here's what they, in terms of exit, another study actually, in terms of months. If you look at the 50%, which is the median, Exit after initial filing, probably fail in those cases, 5%. Exit after demand negotiation, 6.5 months. Exit after board representation, 15 months. Exit after proxy contest, 18 months. So the average per campaign is 9 months. That's 171 hedge fund with 1,023 unique targets for the period 2000-2007. There's short-term impact of activist hedge fund. That we are shown quite often. This is in fact, most of the studies looking at the impact of activist hedge fund tend to focus on short-term, because that's fairly easy to show statistically. Long-term becomes messy, as you'll see. So basically, from T0, 13D filing, you have this curve going up to then and then going up to some like 7%, and that's abnormal return to a 13D filing by hedge fund. The point is, though, that all 13D filing have the same kind of impact. If you look on the left, you have hedge fund, but look at insider, holders. Only financials go a bit lower, around 5%. But 13D filing, in this case, they looked at, they're pretty patient guys, 3,265 hedge fund events and 44,596 non-hedge fund events between 1985 and 2012. And look at what happens after the announcement before. 22 days before and after the announcement. And you see the same pattern. So it's not unique to hedge fund. It's the 13D which tells the market something is happening here. Better get on board because maybe something positive is going to happen. Long-term study. There are several studies on the topic. The best known and most quoted, op-ed, Wall Street Journal, is BERCHUK, Brav, and Yang, 2013, which kind of a respond to a dare by Mr. Lipton to say, well, why don't you try to show? It's important to say that because it tends to, we all have biases, obviously. But to say I start a study and the purpose of my study is to show that there is long-term benefit, or at least no long-term negative effect of hedge fund, and I start with that, and I start cranking the statistics with that kind of goal in mind. It's always a bit delicate. You tell students, here's a bunch of data, go through the statistics, and a so powerful algorithm now, you can play with them. What I want to show is this. I bet you they will find it. You have an A if you find it. Otherwise, you're failing. So, here's the op-ed on August 7, 2013. Our study used a data set consisting of the full universe of approximately 2,000 interventions by activist hedge fund from 1994 to 2007. During the 5-year period following the intervention, operating performance relative to peer improved consistently. Contrary to the belief that the market fails to appreciate the long-term consequences of activism, long-term shareholders don't suffer any negative abnormal return during the subsequent 5-year period. Now that's the program. That's the op-ed. You look at that, wow, pretty impressive, pretty impressive. The reason why we got interested is because it was put as an op-ed in the Wall Street Journal. I mean, studies come out on SSRN every day, doing this or that, showing that, not showing this, not showing that. I mean, you go crazy trying to analyze all of them in detail. But this is an op-ed saying, now we have proven that. This is done forever. Well, what actually have they shown? Don't forget there are 2,040 actually cases. Now we go to event year, we're down already to 1584. Now there's 500 roughly, or 440 missing, and we say, where are they? We don't know. Are they cases that fail? Hedge fund failed to get what he wants, so they removed it? We don't know. 5 years at the end, we're down to 694. So what happened to the 900 in between? We don't know. They were sold, they were merged, they were liquidated, we don't know. We don't know. What's the impact on our ROA, return on asset? adjusted for industry. In other words, you take industry and you take the average versus the industry. And what you get is that at the beginning, on average or median, they were minimally under the average. And in terms of the average, after 5 years, they're minimally under the average. So, well, if there was a major impact of hedge fund, I don't see it. It doesn't move, hardly moves. Moves positively in the right direction if you want, but it's very, very small. Then they look at Tobin's Q, which is basically market value of it should be market value of equity and market value of debt divided by book value, but market value of debt is difficult, so they take book value of debt. It's a very bad issue, actually. But anyway, it's there. Tobin's name is on it, so it sounds good. But basically what they have is an average that goes again, which is remarkable. Intervention leads never to companies beating the average of their industry. You'd think that it should move dramatically if what you're doing is so good. And again, you see the number 1611 goes down to 710. We are not told why. This is graphically what you find ROA and the average and the median for ROA, the median and the average for Tobin's Q. Look at this curve and you see, I've seen studies that show results like that for other reasons. Let's see. This is a study by McKinsey of companies classified by quintile and whether at the beginning they were at the top or at the bottom in terms of performance, ROIC, return on invested capital, which is more or less the same as ROA. What you see is those at the bottom sort of move up and those at the top sort of move down. Then they do the same with EVIC, enterprise value invested capital, which is pretty close to Tobin's Q, the same meaning. And you see the same thing. The bottom quartile goes up, starts low, and then moves towards the mean. Of course, it's called reversal to the mean. It's well-known statistics, reversal to the mean. Actually, if you put together, in red, this is BERCHUK et al.'s Tobin's Q curve from the, and in yellow, it's actually the bottom quintile of the McKinsey study of those years. If you don't see a parallel between these two curves, this is, in other words, without any intervention, McKinsey has no intervention. They just took the statistic and looked backward and forward. And what they find is that the companies who are at the bottom quintile, they sort of move up like this. And now we have companies at the bottom, or not at the bottom, but picked by BERCHUK, and then they move in that same direction. I would tend to attribute that to phenomena which are not necessarily the ministrations of activist hedge fund. But there's worse here because they say the most exhaustive, everything 2000, as if it's simple to find these interventions. These are studies. Even the first three columns are actually from the same people, because Brav Yang are the two authors with BERCHUK, with the numbers of hedge fund intervention. And you see the numbers vary quite substantially. Then you go to other authors who also claim to have looked at the number of intervention, and you see very different numbers, depending on definition, and how they define intervention, how they define... and worst of all, there is a recent study where the people they put that in a footnote because they're very careful, but they say we had access, we look at BERCHUK, Brav, and Yang, or Brav et al.'s data, and we look at the first 80 cases, and we found that 27 of them, there was overlap between our database and them. We had the same. But then in 19 cases are in our sample, but not in Brav at all. And 34 cases are in Brav, but not in our sample. Reasons for non-overlapping sample appear to be differences in exclusion criteria and search technique. It's not that simple to get at the right number and what is actually an intervention. And finally, just data from the Brav Yang database, because it's the same data bank which is used, produced about 50 papers so far, including the BERCHUK paper. I mean, the median market capitalization is 134 million. I mean, half the company have less than 134 million in market cap. I mean, we're talking a pretty small company. And again, just one example. You see, we have, compared to match firm, well, if you look at the market cap of the average market cap of match firm, it's actually 2.7 billion, where theirs is 100 million. So the huge difference between the match firm and so on. So the others have not demonstrated that activist hedge fund per se create lasting long-term value. Their sample data with all its limitations show no longer-term reversal of performance. In other words, didn't go down year 4 or 5. They show that activist hedge fund produce short-term abnormal return, but the same result is observed for most 13D filers. When activist hedge fund brings some lasting value for shareholder, it often takes the form of wealth transfer from employees and debt holders rather than wealth creation. Now, the same authors write this because they look at firm by firm and operating firm. Our result in this section suggests that target firms' workers do not share in the improvement associated with hedge fund activism. They experience a decrease in work hours and stagnation in wages, while their productivity improves significantly. However, the relative decrease in productivity adjusted wages from above par level suggests that hedge fund activism facilitates a transfer of labor rents to shareholders, which may account for part of the positive abnormal return at the announcement of hedge fund intervention. Brav, Yang, remember, are two authors with BERCHUK, so they're not opposing. On the contrary, they think this is good. They think this is good. It's proof that it works. Now, bondholders, we find that hedge fund activism significantly reduced bondholders' wealth. Confronted campaigns and the acquisition of at least one seat on the target's board elicit more negative bond returns. We also find an expropriation of wealth from the bondholder to the shareholder. Moody's came out and says we find that shareholder activism effects on the creditworthiness of Moody's rated issuers is almost universally negative, even if only moderately. As short-term shareholder activists have become more influential, we have observed numerous examples of concession to activists that have eroded credit quality, contributing to downgrades. Standard & Poor's, a couple of weeks ago, well, 2 months ago, Standard & Poor's has lowered place on credit watch with negative implication 1/3 of its rating on companies that initiated spin-off. Of course, spin-off is one of the, I mean, it's really becoming the standard almost now, spin-off transaction. Long-term credit quality for companies that execute a spin-off has deteriorated as well, since about 40% of these issues now have lower ratings. And this is a study, shows the graph on the left, shows the cumulative abnormal returns, 22 days before and after. That's the curve we saw. But then, if you look at T0, non-investment grade, you see a drop in value, and investment grade drop in value significantly. So what is that if not transfer from bondholders to shareholders? I think this graph is pretty eloquent, and it's done with 96 to 2008, 1,332 target firms. So it's a large sample. And again, you see, well, why don't you question those? These are just, I like statistics which are descriptive. I mean, they're not doing, 15,000 different regression to get at that. They just go through and say, all right, let's examine one by one what happens 22 before, 22 after. That is very useful study, very useful studies. Activist hedge funds operate in a world without any other stakeholder than shareholder. Please believe me, that is indeed a myopic concept of the corporation bound to create social and economic problems were that to become the norm for publicly listed corporation. And finally, this is my personal illustrate the limits of the economic toolkit. I say it's with pain. I say that with pain because I taught econometric and multivariate statistics for years. So its weak ability to cope with complex phenomena, and when it does try to cope, it sinks quickly into opaque computation, remote from the observation on which these computations are supposedly based. Now, there are two other recent studies I want really to show because they just came out, one on October 30th and one a bit earlier, purporting to show positive long-term effect of hedge fund activism. One is by Gao Xin, activist director. Now they're going at companies where activist investor won board seats and look at them versus other. And the other is also the same. And the title is The Long-Term Efficacy of Shareholder Advocacy in the Boardroom, available at. And actually in the subtitle, it's that they have debunked the notion that it's not a good thing. Now, these people, activist directors, appear to be associated with significant strategic and operational changes in target firms. We find evidence of increased divestiture, decreased acquisition activity, higher probability of being acquired, lower cash balances, higher payout, greater leverage, higher CEO turnover, lower CEO and reduced investment. All of that is good. All of that, I mean, that's what you want companies to do, no? These auto fine. Yet, what about return to shareholder? What I find surprising is, and I congratulate them for being so honest, they show results. You have number of events, non-board related activism. So all other kinds of activism, hedge fund activism. Activists demanded but did not win board seats. And the 31 activists were granted one or more seats. So you have 456, 424. Large number of events. Raw returns. The winner, but did not win board seat. Size adjusted return, the winner did not win board seat. And even FAMA French three-factor adjusted, which is basically an alpha measurement, the winner, activists demanded, but did not win board seat. That's in the paper, which says it's a great thing to have these guys on board because they bring all of this good stuff we saw earlier. Goodwin is the other one. This is Myopic Investor Myth Debunked. Oh, that's the title, yeah. Myopic Investor Myth Debunked, the long-term efficacy of shareholder advocacy in boardroom. Now, board seat grant date. So the red line, there's no board seat given. And the yellow line, there is a board seat. So, in time, they see that the median, which is the graph they show, the median shows what they want to show, that it's doing, one is going up, one is going down. Then they don't show the mean. The graph is not presented, but the mean shows a less favorable picture. Something happens in year 5, but to say because I voted against the nominee of hedge fund 4 years ago, that explained the performance at year 5. I find that difficult to believe. That's really difficult to believe. Then the Q ratio. They present this Q ratio, which shows again that where the board nominee were defeated, hedge fund board nominee, that is doing quite well and better. And in year 5 again, something happens. I don't know what, but I suspect it's not due to the election 4 years ago. But then they don't show this one is also median, not presented. Then the non-board, or the red line, is it doing even better 4 years after, than year 5 something happened. Still, it's still better than the companies where a board seat was granted at 1.9 at year 0. So it's still better 5 years later, although at year 5 something happens in the company. So it's not a very persuasive conclusion. Now, what is being also spillover effects of activism, which is a nice economic jargon, again, term to mean are companies doing it preventively and proactively, even before hedge funds show up. And there is evidence of that. We document strong industry persistence of activism, which is seen as a threat to yet to be targeted firms in the industry. Our results demonstrate positive real externalities of hedge fund activism, establishing that the impact of activism reaches beyond the firm being targeted and may have been underestimated in previous studies. We show that managers rationally respond to the threat of activism in the way suggested by anecdotal evidence. This study shows that hedge fund activism has a preventive effect. in proactive response to an increase in the likelihood of hedge fund intervention, again, firms cut. COP, reduce cash holding and leverage, limit capital investment and R&D expenses, and raise shareholder distribution and CO turnover. As a result, these policy improvements, return on asset increased significantly. This is all good. By showing that the hedge fund activity is an effective and viable mechanism for corporate governance, the study allows policymakers to make more informed decisions as they face heightened pressure to increase hedge fund regulation. Now, let's imagine the industrial structure resulting from generalized hedge fund administration. Whether from actual attack or from proactive, preventive moves by corporation. We should witness the following on a massive scale if we believe the academic advocates of hedge fund. Increased divestiture, decreased acquisition activity, higher probability of being acquired, lower cash balances, higher payout, greater leverage, higher CO turnover, lower CO compensation, and reduce investment. Or firm would cut COP, reduce cash holding and leverage, limit capital investment and R&D expenses, and raise shareholder distributions turnover. Now, what kind of industrial structure does that make? I don't know. I say it's a fairly dismal world, shorn of long-term investment, of concern for any stakeholder other than shareholders. Corporate management, already pushed to short-termism, would be driven to implement hedge funds' favorite initiative. Now, the essential facilitator of active hedge fund, I've said that in Canada, I don't know if I can say that here. I told them, I think you're the Dr. Frankenstein of this because you're the one supplying the money. You're the creator. Without the money of public pension fund, they're small. And we know when they go public because they have to divulge that. If you look at Blackstone went public, of course, KKR and so on, and they have to show the spread. More than 2/3 of the fund come from public pension fund and endowment. Without that, they're small. Without that money, they're a small player. They'd be around, but they're a small player. And I say, why? Well, institutional investor and their soft activism targeting any and all defenses of board against unwanted takeover and pushing for a shareholder-centric form of governance also contribute. They're also facilitator, I must say. And of course, proxy advisory as cheerleaders of activist hedge fund. Are there countermeasure? Yes, some. And some investor could adopt a longer-term perspective for their holding, refusing to support the hard activism of hedge fund and recognizing the responsibility of public corporation to multiple stakeholders. They could, as per CalPERS, divest of hedge funds. You'll have a test of that in coming, certainly in Valiant, Pershing Square versus Allergan. We'll know where they stand. PepsiCo versus Triumph Fund, if it does come around to a vote at some point, maybe not. But it's an interesting PepsiCo because Mrs. Nui, the CEO, has this notion that companies have to serve communities, employees, and shareholders. But in July 2001, she had to change the guidance of the company from double digit to sort of high single digit. That's from that point on. I mean, they unleashed on her. Is she ashamed of selling? Focusing too heavily on healthier product. Imagine what an incredible sin. Focusing too heavily on healthier products. And Mrs. Nudi set the company on a healthier course. Virtuous this may be, but has not been good for the bottom line. Now, of course, Mr. Pels showed up and said, well, 59-page, again, white paper, the status quo is unsustainable. Should be divided, of course, in two companies, beverages and snacks, and I would create 25% return for investor in 2.5 years. The problem is, of course, now Coca-Cola has had problem. During those days, the blue line sort of moved lower than Coca-Cola, but now, in the last couple of months, it sort of moved ahead we don't see it? Anyway, it's there. And I know in 2013 annual report, she repeats our message that if our financial success comes at the expense of the environment, our consumers, our communities, we will not be viable in the long run. my question to her and to all CEOs who believe that, is she right or is she the forlorn defender of a bygone epoch? Will institutional investors support her strategy or will they side with the hedge fund? The test is with them. Finally, different forms of ownership. I know you can't change those who are there, but looking forward and control dual class time or time-phased voting. I say imitate what private equity fund, hedge fund do when they go public. Now we have large companies in the US who have two classes of share and do quite well. But you also have Blackstone, KKR, Apollo, Pershing Square Holdings, Third Point, who have dual class of share. Now they're the ones saying, no, shareholders are the total owner of the company. The will of the shareholders should be the only guidance. But when it comes to their own company, somehow it doesn't work. They want control. They want total control. They don't want anyone to tell them anything. In fact, if you read Blackstone and KKR, it's amazing. You don't even hold an annual meeting of shareholders. They don't get to elect the board. None of that because they're supposedly publicly, they're limited partnership traded. So they don't have to abide by any of Sarbanes-Oxley, any of that. It's remarkable. I think why private companies are so stupid. Not to imitate that. So we also want that. We also want that. I mean, that's good for you, it's good for us. I just said in dual class of share in Canada, we have a little thing. When they do studies in the US, they always fail to look at that. What we have, which is very important, it removes the premium on the controlling share. If you have a coat tail with shares in Canada, you cannot sell the control without the minority shareholders being offered the same price. So if you have that, there is no more premium control to control. There is a premium, but it's not, you don't accaparate it, you acquire it only and let the poor minority shareholder without it. And of course, I believe in that. I still believe in boards. Yes, boards have been, some of them have been weak. Some of them I think have been weak because of the very nature of governments. But I believe we can transform government. I still believe in that. I have more activists on board. Start moving away from this absolute independence. I would rather have some credible members who don't meet all the finicky criteria of independence, but bring in-depth knowledge of the industry, depth knowledge of the kind of sector in which we operate, not some CEO experience in companies which are totally different in their dynamics and issues and challenges than this particular company. They're all kind. Anyway, I won't go further because that's a subject for discussion another day. It's also a book we're going to come out with. Thank you very much.